Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
I hope you're ready for self-storage. Even if this isn't an asset class that you're interested in now, down the line, and if you're looking for something that's a little bit more passive, self-storage may be an option. Of course, it's more passive when you're an LP in a self-storage syndication, but Tom and I talk all about self-storage as an asset class, even going down to how you buy it, how it can be operated, where you can upgrade, and where there's money to be made. So get ready for my guest, Tom Dunkel of Belrose Storage Group. Let's go. This is episode 180 of Zen and the Art of Real Estate Investing with my guest, Tom Dunkel. Tom is the Chief Investment Officer of Belrose Storage Group, and he brings almost 30 years of real estate finance and investing experience. He manages the firm's financial underwriting, playing a critical role in creating win-win, one of my favorite words, deal structures that ensure achievable investor returns. Tom, welcome to the show.
Jonathan, hey, it's great to be with you and all your loyal listeners. Thanks for having me.
Yeah, I'm always excited to talk self-storage because I feel like it's actually closer to passive income than most other things. Let's start there. Why is self-storage more passive than your traditional investments that we hear a lot of other people talk about, just in comparison, and then we'll get to your background.
Sure, yeah. Well, self-storage is a great passive investment vehicle. We love it because obviously it's real estate, right? So it's secured by a hard asset, yeah. Right? So it's not like my internet stocks in the early 2000s that literally went to zero.
Yeah, but boy, they had potential.
They did have a ton of potential and big advertising and IR budgets too.
Yeah.
But anyway, we can get more of that later. But and then, obviously it's a cash flowing business. We have customers that are paying to rent their units and keep their stuff there. So we have that cash flow coming in. And then, of course, over time, self-storage, like other asset classes, tends to grow over time. So we get the security, we get the income, we get the growth. And those are three really great characteristics for a passive investment.
Yeah. And even as a GP in self-storage, I find that if you're looking at it just as an asset, of course, it's easier because there's not actual tenants living there. You have tenants, but the tenants are just like memorabilia, boats, and that takes a little bit of the pressure off, don't you think, compared to multifamily?
Absolutely. As a recovering landlord myself, yes,
we all are.
I am very happy that my tenants are just lifeless stuff. Although they do like to, some tenants do like to try to live in the units from time to time. We got all kinds of stories we can get into today, Jonathan. But for the most part, we have no tenants, and there's no toilets, there's no plumbing, right? So you're not getting those calls in the middle of the night or over the weekend or on a holiday. And it's just a great. I don't want to say easy because, of course, every business has its own such challenges as this self-storage. But as compared to other classes of real estate, I'll take self-storage.
Yeah, no tenants, as you said, no toilets, usually one just for like one person. And then it's usually fire resistant, at least structurally. And those are huge things. But comparatively, it just seems like it is a good thing to mention, like, hey, let's not call it easy because, like, as you said in the beginning, you're still running a business, but it's so cool that you're running a business on top of the existing real estate. So if that business wasn't working perfect, you can always upgrade. But I do think, and I want to get your take on this, especially for people starting in self-storage, I think they think that the business is going to run itself and they don't realize how much you need to do up front, but then how much that can make you if you do it the right way. I mean, that's the business that you guys are in.
Sure. Yeah. I mean, we leverage technology, Jonathan, so we can have, back in the old days, it'd be, one person is running one facility.
Right.
And, but most of the time, if they're doing their job and the facility is over 92% occupied, they're just going to be sitting there twiddling their thumbs all day getting paid. So we try to avoid that. And of course, the smart people in your audience know that personnel expense is one of your biggest expenses when you're running a business. So using technology, we are able to have one manager run 4 or 5 or 6 facilities, even if they're not really geographically in the same location, because they can handle most customer calls from their smartphone, and they can take payments from their smartphone. They can, handle most customer service issues, moving people in, moving people out. Everything's on our technology platform, which lives in the cloud. And so we were able to really leverage technology to streamline the process. And as an example, most people who rent a unit at a storage facility have driven by it.
Yeah.
And so you might wonder, well, geez, if someone's driving by and there's no manager there to field this customer, aren't you losing out on, a conversion opportunity? And we obviously, it depends on the individual customer, but there is a QR code on a sign on the gate.
Yeah.
They scan the QR code. They can pick out their unit, fill out their paperwork, sign with their finger, punch in their credit card information, which goes on auto pay, which we love.
The best thing about self-storage.
Then it's like a Planet Fitness membership, right?
Yeah. Did I still have that from 2017?
Yeah. Yes. Because it's more of a pain to cancel the membership than it is to just keep paying your $100 a month or whatever. So then once they fill out their paperwork, the gate code gets texted to them. They punch in the gate code, gate opens, they drive in, empty out their stuff, and then leave, and away they go. So without interacting with a human, they can go ahead and purchase, rent a unit from us, which is great.
And I would think that in most of the areas where you guys are buying or where people are going larger scale, the people who need that one-on-one attention, not your ideal avatar. If you're in the Midwest and it's a very rural self-storage, that's probably going to need someone at least to be able to be called on a landline. But that's not what you're going after, because there's not really scale in that.
That's right. And by the way, with the QR code, there's also the phone number. So if someone's not comfortable using a QR code, they can call the phone number and just do business with the manager that's going to answer on the other end of the line.
Mm-hmm. Yeah. I mean, I think when I look across the asset classes, I think technology has helped self-storage more than anything, especially with what you do, because you can scale you can change from a mom and pop to something that's modern with really a few tweaks that are not very hard to do financially. Like, you don't have to go into an entire overhaul because the structures are usually pretty good. It's just about how you outfit them with the technology to make it work. You have cameras on the front, so you can kind of see what's going on. Every time somebody clicks in, as everybody knows from Johnson Control cards at my previous government job, it's like they knew you were there. It's oh man, you can't really get away with much in a storage facility.
That's right. Yeah, we have security cameras in place, and of course lots of lighting to try to keep things safe and secure. But yeah, the technology has definitely helped us out a lot. And just another little example of that, Jonathan, is at our boat and RV facilities. Of course, if someone's pulling up in an RV, they don't have a door right there, and they can't really reach down and get to the keypad. So we have technology where they can just punch in their gate code on their smartphone, and it opens up right there while they're sitting up high in their RV.
Yeah. And I mean, I think the little touches that make it easier also make it easier, as you said before, like when it goes up $5 a month, you're not going to spend $400 to move your stuff to another. That's the power of self-storage. It's a business portal, and it's still worth it. But I also see, before we get to your backstory, self-storage to me, I really consider to be recession-proof, and I actually think it's probably it might go up during a recession because people are going to be downsizing. And then when they're upsizing, everyone has too much junk. I mean, not everyone can be Marie Kondo, so they're just filling up their stuff. So have you seen that across the board with all of your investments, that no matter what the economy does, self-storage is one thing that's staying on? You're not even going to really be losing on the rates because they're all set up.
Sure. Yeah. I mean, look, when we had the crazy year last year, when interest rates went up 500 basis points, and one of the big drivers of self storage demand is residential real estate transactions, and so when the interest rates went up and the transaction level went down, that absolutely had an impact across the self storage industry. So our occupancies were down, and our rates were down in some places, but that that doesn't happen, very very frequently. And in fact, in our investor pitch deck, we have a chart in there that shows for the past 40 years, self-storage occupancy rates have gently meandered between like 80 and 90%.
Yeah.
And to your point, across those 40 years, we had booms, we had busts, we had crashes, we had pandemics, we had, everything in between, but self-storage occupancy remained very, very, very steady. And to your point, people need it when things are bad because maybe they're selling a house, or there was a divorce, or some kind of downsizing or dislocation or death, or, the D's, as we call them. And people need a place to put their stuff. And then in good times, consumers are buying more stuff, that, they're buying the toys, they're buying the, the bikes and the fun weekend car and that sort of thing. And they will store those at self-storage facilities. So it does well in good times and bad.
Yeah, I don't think anybody is mad that they have a storage unit. Like, you could just get rid of it if you don't want it. It's just more junk that you don't need in your basement, or that you need specifically for a time frame, and it's easier to go pick it up. Again, easier access, the better, I think, for the modern consumer. And I was just thinking before, like you were saying, in terms of a traffic and having people there. I mean, I used to go to my storage facility all the time, and the amount of times that I was ever in a 200 unit facility with someone else was like 4%. It's like you're getting maybe like 2 to 4 visits a day, I would guess.
That's
at
right.
200 units. I mean, that's like low foot traffic and low risk.
That's right. Yeah. No, you're spot on. Once people put their stuff in a unit, when they rent a unit, most customers say, "Oh, I'm just going to have it for a couple months," and then a couple of years later, they're still there as a customer. I mean, we have one facility where our average customer has been there like 2 years and 9 months or something. It's like it's very, very sticky once someone starts using a self-storage unit. It's out of sight, out of mind, right? So they've cleaned out the basement. They turned it into the man cave that they've been wanting.
Yeah.
And then they're like, oh, where's that stuff? I don't know, but I keep paying this $150 a month every month on my credit card, and I'll get to it next month.
Yeah. I think that, I guess probably before the pandemic, but I think people started to figure out how to use self-storage a little bit better as a business, for people who couldn't find like a local garage or something for a business. As long as the access easy, they're, barring the people who are trying to stay in them, which I definitely seen. It's been featured on a lot of shows, so people get a bright idea like that. But there are a lot of businesses that you can run out of that storage and have it much more secure for your stuff than storing in somebody's garage or your own garage, that just pulls up and someone could just take all your plumbing supplies.
Yeah, Jonathan, you're actually spot on. And that's one of the niches within the self-storage niche that we're really excited about is what we call pro storage. So this is storage used for commercial purposes. So think, landscaper, HVAC guy, plumber, pharmaceutical representative, right? So when the residential real estate transactions really slowed down, like we talked about a minute ago, as a company, we were trying to think like, well, how can we, mitigate this risk in the future? And the answer was, hey, we need to shift our revenue mix to, virtually 100% residential, what we call retail customers, to more a mix of commercial customers, because commercial customers are going to be better payers. They're going to stick around for longer. They're probably going to be less sensitive to rate hikes and that sort of thing. So,
well, because they'll also be your highest users. So rate hike to them, it's like, why come here every day? So they're really like your most ideal user, at least in terms of the facility, without putting wear and tear on it.
Yeah, absolutely. And it's going to be tax deductible for them on their business financials. But we're actually pushing hard into that niche, and it all, the other thing that happened that really shined a light on that niche for us was, just like a lot of things you do as an entrepreneur, you sort of stumble into something by accident. And so we bought a facility in Wilmington, North Carolina, a little over a year ago. and 80% of the customers were commercial customers.
Mm.
And because these were not your typical 5 by 10, 10 by 10 with the 8-foot roll-up door. These units were 18 by 25 with a 14-foot roll-up door and a 20-foot ceiling. So, you can pull a van in there, you can pull a pickup truck in there, you can pull a work truck in there, you can store equipment, materials, tools, whatever. And unlike our retail storage facilities, we will put some extra lighting in there, so maybe an electrical outlet or something like that, which we try not to do at our retail facilities because that just invites all kinds of problems. But now, as we've seen this facility has been performing like gangbusters, we've been able to push rates and keep the units full. Now we're trying to find more of these to buy. Problem is the ones that do exist out there, and there are a handful, they're pretty few and far between. But the owners of these facilities they know they're sitting on a cash cow, so they're not looking to sell for any kind of reasonable number. So we're actually building out a whole business plan as we speak to go to some institutional capital and build out that segment of our business by finding dirt and building these things, because they're very much in demand for sure.
Yeah, I think it makes sense. You look at the pandemic and a lot of people realize, like, I don't need a storefront to be a plumber or electrician. Like, I'm not going to sit there and then I need to pay someone to sit there, like we were saying about self-storage. Now I can just have a roll up, if you can get the vans in there, even better. I've seen that adjustment in the flex industrial also, which is obviously like a cousin, because that can be more office related. But I had a friend who actually, myself and one of my friends, we were both in the art world for a long time. And we both used storage facilities as off sites for our galleries to have like kind of a little bit more cool shows, because they were very secure, they were fire resistant, and you could just roll up the top and have people there. And it was always in an area where no one was, tons of parking. So there's a lot of interesting ideas, I think, as things begin to flex, like flex industrial. And you're right on it with this. I mean, I think this, commercial level is really, really smart. And as you said, it might just be easier to start building it and then target that, because it's a commodity that might look like something, they know what it is, and then they realize, wait, I can save $1,600 a month, and Agnes's pay every month. It's really interesting.
Yeah, that's right. Now you're spot on. And really, it is the rise of e-commerce that is really driving the demand for this kind of unit, because the Amazons of the world and those e-commerce companies, they're eating up all of the available flex space and pushing up the rents and squeezing out the small mom and pop contractor that used to rent that space. So, and that's a trend that, that's a global trend, right? I mean, that's
for sure.
I mean, I think their stats are out there. Over 20% of all retail transactions are e-commerce transactions these days. And of course, that number is just going to be increasing.
I can't even remember the last time I went to a store. And it's a lot of times where I mean, like growing up, I used to go to the mall and I used to take my daughter to the mall when she was younger, but it's like, for me, it's ease of use, like a who, not how. I don't want to spend that time. So I think, I think the companies that are adjusting along the way, and like you guys seeing like, hey, look, there's an avenue that not a lot of people are doing. That's how you can get way out in front of it. Because,
that's right.
We go on podcasts where obviously I want to know. You can tell everybody the secret to everything. It doesn't mean that they're going to go do it. There's a lot to go in and do it. Hey, it's Jonathan. I hope you're enjoying this episode with Tom Dunkel, and I hope it's putting some ideas in your head about self-storage. Maybe it's not for now, maybe it is, but is this an asset class that you might be interested in the long term, because it's a little bit different, a little bit more passive. You're still running a business, as we talk about a lot in the episode, but I hope it's just opening your eyes that there's other asset classes out there. I personally enjoy learning about them all, so I think it's a good idea to learn what's out there for, if not now, maybe later. Let's get back to Tom. Before we get to like the demographic research and areas that you guys choose, I wanted to drop back on your background. Sure. When you were younger, when was the first time that you were interested in just real estate as something that you remember being like, oh, that's interesting?
It's funny. I guess this type of thing might skip a generation, because I remember going to my grandparents' house in Florida, and they had some properties. And I remember my grandmother sitting in her garage. It was her office. And she had like these file cabinets around, and she, I guess I asked my mom like what she was doing, and my mom said, "Oh, well, they have these properties." And so I started hearing these stories as a young kid. And so here's one of them. This is a funny story.
I'm ready.
So my grandmother and grandfather, they used to buy this back in the 50s, right?
Yeah.
The 60s. They used to buy and fix up and sell houses. Sound familiar? Yeah. So it's been around for a while. But my grandmother was an awesome decorator. So they would get the house all fixed up. My grandmother would go in and have it all decorated. And,
way ahead of our time.
Yeah, right. Yeah. So this one particular house, my grandmother and grandfather decided to move into. And this was when my mom was away at college. And so one time my mom came home from college, knocked on the door, and somebody else answered the door. Her parents had forgotten to tell her that, someone came along and they loved the house so much that they just bought it right from my grandparents. And my mom showed up at this house not knowing like where her parents were. So anyway, so we had a little bit of that kind of going on. And my grandfather was also a builder. Don't fact check me on this one, but I believe my grandfather was one of the first developers to offer seller financing.
Wow.
On a property.
Yeah.
Because he would build these houses and he would sell them, and sometimes he would hold the paper on the property. So then here along come my parents, no interest in real estate whatsoever.
They just were like, that's annoying.
So I guess I heard these stories as a kid, growing up. I was like, oh, that's pretty interesting. And then we can get more into my background later, but I'm a finance guy by training, MBA and accounting and all that dumb stuff. So I've always been interested kind of in the number side of things, but then also, really like the real estate side of things as well. So that always kind of intrigued me. And so I guess it's just funny how things work out that way.
Mine did not skip a generation. My dad was your grandparents, and every time that the house got perfect the way we wanted, we would have like full court basketball, hockey. He's like, we're selling it. And I'm like, are you serious, dude? Yeah. This is the greatest house ever. He's like, well, we're going to get paid this much. I'm like, okay, that makes sense. You really, even as a kid, you start to go like, I could be annoying, but that really makes sense. Like, why would you not take that as an offer and then move it forward? But it's interesting because even if you go back to your grandmother's garage, that's almost like a storage play because she had the file cabinets in there. So you're repurposing this part of a property, which I think is interesting. But in terms of your finance background, why real estate over other investments? Because a lot of people who come from finance still interested in stocks. I still have a ton in index funds, but I like to balance and diversify my portfolio as a whole. But for me, real estate, it's so tangible and you can value add, like especially with self-storage. It's like, wow, did you just see how much we increased just by doing, this little bit? Is that where the big difference is for you between traditional financial investments and real estate?
Yeah, pretty much. Yeah, you touched on some key things there. But as far as a little bit about my background, like I mentioned, I was finance and economics undergrad. I was finance and accounting in business school. Went into mergers and acquisitions in the aerospace industry, where I was exposed to, this is my first exposure to the big private equity world and the lending side as well. And in fact, they syndicate on the lending side. A lot of people might not realize that, but when you do a big loan, like we did $140 million revolving credit facility, that bank, there will be a lead bank, and then they'll syndicate out the rest to other banks. So I got exposed to that kind of syndication idea, etc. But I went on to work for a couple of publicly traded companies, and which was great. Again, great experience, and just being with these companies that were growing through acquisition and really using the financial markets. And so I learned a lot of nuts and bolts of how the financial markets work and the different types of financing vehicles and all that kind of thing. But the one thing that frankly kind of turned me off about it was, well, first of all, I was working for someone else, working long hours, making someone else a lot of money. But, I saw in the publicly traded companies I was with, like the information that they put out to the public, I didn't feel very good about how transparent they were being.
Yeah.
And I felt like there was like a lot of spinning going on. So if any finance nerds like me out there have ever read like a 10K annual report or a 10Q quarterly report, there's this section in that document called the Management Discussion and Analysis, the MD&A. And so I would write that. I would analyze the financials, and then I would write that, and then I would turn it into the CFO, who would review it with the CEO. And when it came back to me with the edits,
what's this?
I was like, "What? This is not what I saw."
Here where you told the truth. You really need to blur that up a little.
Yeah. So it definitely turned me off. And I'm sure, look, there's plenty of companies out there that are very transparent, do great things. I felt like one of the companies I was with, I felt like was pretty straightforward. The other one was like a little cray-cray. But, but having that experience and then seeing, people really get hurt in the .com bubble and that sort of thing, it kind of turned me off to the public market. So I like what you said a minute ago, Jonathan, about you're in index funds. And so that's what I do now, because look, I'm not going to sit here and say, hey, everybody needs to invest all their money in self-storage. Of course not. I think, but if you look at the wealthy families in our country, they are diversified. They have about half of their portfolio is in publicly traded, stocks, bonds, mutual funds. And then the other half is in businesses, real estate, et cetera. So, more the, alternative asset classes, which, by the way, bugs me. What's more traditional than housing and
real estate
and lending,
or a piece of paper
and real estate? Yeah, it's like that to me is like the real investing.
Yeah,
stocks, bonds, they are derivatives. They are alternatives.
Exactly.
But the Wall Street propaganda engine out there with all of its money, they have brainwashed us all to think, oh man, if you're making 10% on a diversified, portfolio, wow, you're really doing great. And here's diversification, large cap, mid cap, small cap, value, growth, blend. That's not diversification. All those had a correlation of 1 when the market dropped in the early 2000s. Everything went down. So, but you know what? My self-storage facility outside of Baltimore, Maryland, is not going to go up or down based on the value of our facility outside of Atlanta, Georgia.
Exactly.
So to me, that is diversification. Definitely go with your index funds. I personally don't feel like, the managed accounts and paying the extra money for active management on the public side of things, I personally don't feel it's worth it. So I like what you're saying about, do your index funds, send your whatever, couple $100 a month to Vanguard or Fidelity or whatever, and just get that going. But you got to get into other investments like self-storage, multifamily, short-term rentals, whatever it is. I was actually, right before I got on with you today, Jonathan, I got my package from my CPA. Finally, because here we are, end of September. The stock filing or the tax filing deadline is coming up, and so I was looking at my K1s, and I was excited because I had a lot of losses. I was like, okay, this is great. I've got these losses from depreciation on these assets that I'm involved with. So, good for me. It's going to help shield my income. So that, coupled with my stock portfolio, I should say mutual fund portfolio. I don't invest in any single stocks. That is to me, that's a great, very solid, more predictable kind of structure for an investment portfolio for people who are, getting to that accredited investor level.
Yeah, it's funny though, because you said that you were saying about real estate and what people think is risky and what's tangible. I was in the forums on Bigger Pockets the other day, and somebody very obviously very, very new was saying like, I have a bunch invested in stocks, but I want to invest in real estate, but it seems so risky. I was like, what? I'm like,
why does he think that?
Yeah, right. Because
I've been taught that,
Yeah, and I just tried to break it down pretty easily. It's like you can go and add value and increase the value of real estate, or you can literally do nothing and sit there and it will go up, and you have control over it. You have no control over what you can do to a stock. You're hoping for the best. I mean, it's not the same as, I'm reading all the articles every day to decide what to do. I mean, okay, but you can't do anything to adjust the value.
That's right. And I'm glad you brought that up, Jonathan, because I meant to touch on that in my in my rant a minute ago. But there's a author out there, Michael Lewis. He writes
wrote Moneyball.
He wrote Moneyball.
Yeah.
He wrote The Big Short, and he wrote a book called Flash Boys. Flash Boys is a book about how the pace of trading, it's so quick and so frequent that these trades are happening so quickly. It's impossible for the average Joe investor to make any kind of alpha, any kind of different spread there, because the market is so incredibly efficient.
Yeah.
And for average Joes like us who are waiting for the 10Q and the 10K to come out, well, guess what? That information is stale by the time those documents come out. All the pros, they already have that information. They've already baked it in their models, and they've already done their high frequency trading to make their little, 30 seconds of a point or whatever. Flip it over to real estate, inefficient market, which is great if you know what you're doing. And, you can leverage, right? You can get some financing. And so like you were mentioning, if like at our self-storage facilities, we add tenant insurance. Okay. It doesn't sound very sexy, but if we can add $9 per month per unit at one of our storage facilities, you add that up over the course of a year, and you throw a multiplier on that, otherwise known as a cap rate, you can create $250,000 of value, $500,000 of value very, very, very easily, just by these small incremental changes in revenue or adjustments in expenses. And that's one of the things that we've been able to successfully do in the past with our amazing operations team. We were able to go in and really analyze the market, analyze, where our facility should be, rate wise, where we should be expense wise, where we can find efficiencies, leverage technology like we talked about earlier. And, you create those efficiencies, and the market will reward you with a much higher valuation. Yeah. Without, this is not heavy lifting, Jonathan. It's not, we're not splitting atoms over here or anything. It's just basic business blocking and tackling, efficiencies, pushing revenue, monitoring expenses. And if you're, it's again, I don't want to use the word easy, but because it can work against you. It can also work against you. But it does give us the opportunity as a professional organization to buy a property that's underperforming. Maybe it's a mom and pop. They don't know. They don't use the latest technologies. They're not going to the industry conferences. Pen and paper, pencil and paper. That's my fave. Right. Yes. And there's plenty of that.
Let me show you the book, and it comes out, and you're like, "Oh, it's going to be a good one."
Oh, yep. But therein lies the opportunity. For a company like Belrose Storage Group, we roll up our sleeves, we get in there, we deal with the pencil and paper books. We bring in our accounting team and our operations team, and we get it all tightened up, and then we're able to, really drive those business improvements to make great returns for our investors.
Yeah, and one thing I also wanted to mention that I think is like really, the difference between stocks and real estate. That is a huge advantage that is going to go into what I'm going to ask you next is insider trading is legal. Like it's actually the way that you do business in real estate is by insider trading. And as somebody who's been involved in the commercial sector with self-storage, where you're not going on Zillow to find a new facility, you know that insider trading is just building relationships, and it's all legal. It's how you do it. But where do most of your deals come from? They come from people that you already are in business with or have developed, and they say, oh, that's Belrose. Like they know what they're doing. This is going to be an easy close, right?
Right. Exactly. Yeah. Can you imagine like going to your stockbroker and saying, hey, I'm a really strong closer. So I want like a 20% discount on those Apple shares. Yeah. I want to buy, they would be, what? Yeah. They'd hang up on you if you could even get them on the phone.
Yeah, no, never, no chance. Yeah.
But you're spot on. We're able to identify those relationships and those inefficiencies, and and take advantage of them for the benefit of our investors.
Yeah, I feel like people forget that the better that you get at something, actually, the easier it is to make deals. But people sometimes look at it like, oh, well, you're gonna, turn off the mom and pop. It's like, no, we know exactly what we're doing, so we know how to analyze their data that they don't even know how to analyze. Which is your classic when you're buying mom and pop. You kind of have to, as you were saying, you need to extract the old world into the future and say, like, well, here we're going to put in this stuff, so these are the variables. And I think the better that you get at it, the easier each deal comes. But most importantly for you guys at a big company, when you're vetting hundreds of deals, it makes it much easier to know which deals are a hard no right away. Like, that one's not even close, you can just pass, so you don't waste time with that. Where maybe in the beginning you were like, let's just try them all, and you realize which ones are yes or no. Is that a huge advantage now with your experience in the business of storage, to know, like, that one's definitely a no, they're not even in the ballpark?
Yeah, for sure. I mean, well, as you mentioned, I mean, we literally are looking at hundreds of deals for every one or two that we buy, because especially at this point in the cycle, Jonathan, like there's still a lot of offering memorandums coming out from the real estate brokers out there that are, the numbers just aren't realistic, or they just don't fit what we're looking for. And look, there are plenty of companies out there or investors. They're just looking to buy what we call a coupon clipper kind of asset, where it's already, the value has already been added. It's stabilized, the occupancy is up, the rates are, right at market, and it's churning away. And some people are okay with that. And hey, good for them.
Different strategy.
So there are those kinds of deals out there. And plus, there are larger institutional style players that have, much lower cost of capital than we do, so they can afford to pay up, and they're happy clipping those coupons at a 5 or 6 or 7% return. Our investors are looking for a little more of a bump. So we do need to do a little more digging, find the diamond in the rough, where we can see the value add potential and then go after it.
Yeah, that makes sense. It definitely requires a better due diligence process than, a REIT that can buy whatever the heck they want at lower caps, like you said, and are fine, because they'll just take the returns of an existing facility. But you guys can really find like windfalls for the investors in self-storage, because as we were saying before, if you just put the $9 a month on for insurance and then put technology on, add a technology fee, I mean, your valuation could go up like $1 million, or like 20-25% right away. I mean, like in a year, without doing any major construction. I mean, what other asset are you finding this available in?
That's right. And why it beats like the residential side of things comes down to the financing, right? So in residential world, the primary driver of the valuation is the comparable approach, the comparable valuation method, right? So like, I have a friend, I'm based outside of Philadelphia, longtime friend of mine, guy I've been mentoring for a while. He's built a great business. He takes a residential property, usually like a triplex, and if it's the right kind of zoning, he can rent it out by the room, and he can add rooms and maybe add a bathroom and this and that. So it's a fantastic model, especially for low income housing kinds of things. It's a great solution for low income housing. But when you have that many tenants in a place, you're getting some great rents. But you're right, high management. So hey, good for him. All I do is lend him money. I let him worry about the problem.
I'm saying, like, there's nothing sounds worse than that.
So he handles all that. But the point is, even though his rents are higher and the thing is cash flowing like crazy, when it comes to financing that asset with a loan from a bank, they don't look at the cash flow. They're looking at the comparable sales in the neighborhood for a triplex. And so he's getting kind of gypped, right? So because he's kind of boxed in to this kind of valuation.
He's a residential asset in a commercial world, and it's a big difference.
Flip that over to self-storage. If we're able to increase the rents and the net operating income, like we've been talking about, we do get the benefit of that in our valuation and on the debt side. And then we can leverage that and generate the returns for investors. So, he my friend Greg, he's in a tougher spot. because he just doesn't have that kind of mechanism in residential world. But in the, self-storage, multifamily, these other commercial asset classes, you can definitely take advantage of that.
Yeah, I agree. And even just adding the technology makes it easier to quantify the gains, because when you're dealing with mom and pop, like their books are average, they like have the original QuickBooks, like it's still called Intuit or whatever was before that. So yeah, you can extract it, and quickly, just by cleaning everything up, you're going to increase the valuation because you can kind of transparently see where everything is. Yeah, I think that's important, and it's a big, differentiator in the game. In terms of storage, what, like, demographically, where do you guys like to buy, and what types of facilities in terms of like high occupancy, low occupancy, depending if you're doing value add? It might be all, but that when I talk to people in self-storage, this always is, I think, the overriding theme. Everybody buys differently. What's your guys' buying strategy?
Sure. Yeah, great question. Yeah, and you're right. There's different strokes for different folks out there. But generally speaking, we are following the demographic trends of people moving out of the Northeast and into the Southeast and the South, right? So there's that kind of migration going on. And another beautiful thing specific to storage is when you start getting south of Maryland, North Carolina, the ground is actually very sandy. And so because of that, you won't see basements when you start getting further south. So, and
I did
in
14 years in Florida, and I remember never had a basement.
Yeah, never had a basement, and it's too hot to go in your attic in Florida.
Oh, yeah.
So those people are looking for storage outside of the home.
Yeah.
And so we're looking at that. But as far as the types of facilities we're looking for, I kind of touched on it a little bit earlier. So we're not in Baltimore.
Yeah.
We're outside of Baltimore. We're not in Atlanta. We're outside Atlanta. Because when you get into those urban areas, Baltimore, Atlanta, Philly, whatever, that's where you're going to find the REITs, right? The real estate investment trusts.
Yeah.
Because they have the big deep pockets, and that's where you're going to find the public storage, extra space.
Right. They look more like an Apple store, but you're like, that's not for me. I mean,
that's right. Yeah. And so they're big players playing with big players, and that's fine. They can go do that. We're having the most success in kind of those secondary and tertiary markets outside of these major metros, because we look for that path of progress. So people tend to be moving outside of the urban areas, and as these new developments come up, that have to house these people that are migrating in somewhere. So as those new developments are popping up, we get the path of progress. What was a tertiary town, in probably 10 years or so or less, it's going to become a secondary kind of town. But you touched on occupancy. We like to see a strong occupancy at a facility, because that tells us that there's demand. I mean, we look at a lot of other demand drivers when we're doing our analysis, but that tells us right there that whether it's the location or the pricing or something, they have a base of customers, but they probably are going to be below market rents. So like we've been talking about these moms and pops, they kind of fall asleep at the wheel is what we found. And especially, during the pandemic, when self-storage became hugely in demand, and professional operators out there were taking advantage of that and really pushing up their rates. The moms and pops, they were kind of asleep at the wheel, and 2 years later, they're looking back and realizing their rates are 40% below where the market has moved to. And so a lot of them say, well, that's okay. I know Sally. She's been a customer a long time. I don't want to.
Sally pays in cash every month. That's not
Sally
efficient.
Pays in cash. Yeah. And then, so the last thing these folks want to do is have any kind of, marketing program or website, or have to deal with any kind of customer churn, because they're moms and pops. This is their primary KPI, their key performance indicators. Are we full?
Yeah.
Because if they're full, then they don't have to do any marketing. They don't have to fill a vacancy.
Right.
Whereas a professional company like ours, we actually welcome the churn, because it allows us to maybe move out a lower paying customer and replace them with a higher paying customer.
Yeah, exactly.
Because we do have the marketing engine. We are doing the Facebook geo ads and targeting people that are within a certain radius of the facility. And we're not afraid of doing those things. And so that gives us the ability to then over time push the rates up to the market. And again, it's not rocket science. It's just business blocking and tackling.
Yeah. And I mean, again, we were saying before, I mean, Sally's not your avatar, the cash paying, that is good for, a very rural area, but still it's not a good business. And the interesting thing, the more that you find out about mom and pops, they don't really need the extra income. It's almost like they don't want it. It's very weird when you look at their prices and you're like, do you know the differential? But they also don't have the security, and it is more of a mom and pop. But that's why they're not even sure, if Sally paid the last 3 months. They think so, but let me check the ledger. Oh, wait, I spilled coffee on that. So,
Exactly.
I don't know. I don't know what that says.
Exactly right. Yeah. No, and these situations exist out there. We see them all the time.
Yeah,
all the time.
Yeah, I mean, I think storage has been on a growth trend for a while. But as I was telling you before we hopped on, I really think that it's an interesting asset class for people who aren't sure what to do yet, because it's very stable. It's like we're saying, it's very recession-proof. It's also very, again, we're not using the word easy, but for strong operators like yourself and who know what you're doing, it's a pretty straightforward value add. Like the valuations, if you're working with a good operator in storage, they're going to be pretty spot on because you've already done it 9 times over here. So you're just going to apply that. They're the 30% below market. We're going to be able to go to 20 up. That's a 50% increase. So these are things that I think could be interesting to people who maybe, they're thinking, hey, maybe I should flip a house and make 80 grand. And you're like, well, you're actually going to lose 25 grand the way you're trying to do it. Have you found that more people are getting interested in self-storage who maybe have more money, but not as much time to do it since it is more of a passive vehicle in syndications?
Yeah, it's such a great question. In fact, I might be a little premature, but one of the strategic initiatives we have here at Belrose Storage Group, kind of heading into the end of the year, and we really want to blow it out next year, is more of a consulting role. Because of our business structure and our cost of capital, we have a lot of deals that we have to pass on, and of course that's a shame because it costs time and money and effort to generate those leads and do that analysis. But what we've been doing recently, just sort of in like a beta test, is we've been contacting people who have been to like a self-storage conference or event or something, and they might have, a couple $100 grand, $300 grand, whatever, and they're looking to get into storage, and they don't want to invest in a syndication. They want to have that control for themselves where they are the owner.
Yeah.
And so we're rolling out consulting practice where we're going to help that person who has that money. Because for 300 grand, you can buy $1 million self-storage facility, which might be a couple hundred units.
Seller finance, you need a lot less,
Yeah, seller financing, whatever. But so we have the experience, we have the back office, we have the technology platform that we can share and consult with this client. And so and for a modest fee, we're looking at providing that service to these kinds of operators who might be more of a DIY guy. They don't want to give up control to syndication. They're not quite ready to make the full leap to become a passive investor.
Yeah.
Maybe they want to take kind of a baby step, and they want to have that control. And then once they see how hard it is, then they'll become a passive investor.
Yeah, but at least you're giving them.
Or not.
Yeah,
it's like
maybe they're good at a business, like they can run a franchise. That's kind of like, hey, let me give you the blueprint.
Yeah, 100%. I mean, look, I was a terrible landlord, and so I couldn't wait to get out of the residential rental business. But you know what? There's plenty of fantastic landlords out there, and they're really good at it. It's everybody. That's why there's chocolate and vanilla, right?
Yeah, I think that's a really, really smart idea, because I remember my friend Ryan, shout out Ryan Goldfarb, we were looking at self-storage. We pulled lists, from a friend, and we had a couple almost scores with mom and pops, but he's really good with the numbers. So when we're going through it, I'm like, you're just like speaking gibberish to me. Like, just, is this a good deal? But like, if we would have gotten one, which we were close really on both, I don't know, like neither of us had the operational experience to then turn it up a notch quickly. So that type of thing I think can really help people, because just last year at 52, I started investing in syndications, and I love it because I really like trusting the operator. I know so many people now from the podcast that I don't really like. My vetting is, these conversations and then talking more, reading I'm not going to get snowed on that, but I like it, but I'm also a control freak. So if I kind of want a diversified project, like I'm just getting back into short-term rentals now. I'm like, well, it's just going to be, it's fun for me. So that I like that idea. I really do.
Yeah.
I think it's very valuable because I think there are people who like running businesses, and again, as we've said from the beginning, cool, self-storage. There's no tenants. Your tenants are documents and old yearbooks, and these things don't talk. And I've always said one of the best things about self-storage is, hey, guess what happens when the tenant doesn't pay? There's no eviction. You just turn their code off and they can't get in. Technology.
That's right. Yeah, that's right.
Yeah. Awesome.
That's right.
So, Tom, is the best place for people to learn about that when it comes out and for anything that you guys are doing at belrosestoragegroup.com?
Yes, sir. Yeah, belrosestoragegroup.com is where you can reach out to me. We have a great resource there for our investor community out there, which is called the SAFE. It's an ebook called the SAFE Investing Method.
Awesome.
SAFE is an acronym. Of course, investing isn't safe, but if you use the SAFE Investing Method, you might be able to save yourself some heartache and pain. Just real quick, Jonathan.
Yeah.
So SAFE, S stands for sponsor. This gives you all the questions to ask your sponsor.
Very important.
Which I wish investors would take more time.
Oh God, me too.
Learning who they're doing business with, as opposed to going directly to the A, which is the asset. The asset that you're investing in. F is for financials. E is for exit. How do you get out of this thing? You can't go to schwab.com and click and sell your position in a Belrose Storage Group deal.
Yeah.
You need to understand that your capital is going to be tied up for a period of time. So anyway, the ebook just kind of gives a little bit of history about me and the mistakes that I made. And this SAFE Investing Method sort of came out of the mistakes that I made and the lessons I learned and the successes that I had along the way. So it's gives some questions. It certainly isn't exhaustive, but it just gives a little story and then some questions to ask when you're getting into an alternative investment deal.
Yeah, I mean, sponsor first is where it's at. I mean, that's the, I learned that quickly that was where I needed to put my energy. Yeah. And then I always look at the asset very hard, but like I already know that like I can trust the sponsor. And then since I'm good at due diligence, I can read the document, then send over a couple questions. When they get answered in 5 seconds, I'm like, I'm good to go. I only need SA. I'm good. But I think it's important for other people to follow a little strategy as they get adjusted to syndication. And would you agree, as someone who, of course, is going to take these questions from people, when somebody comes with smart questions because they've done the research and they're following this SAFE method, those are questions very, not just easy for you to answer, but you're like, I think that's going to be a good investor because they're asking the right questions up front. They're not going to be the person who doesn't know the exit and then after a month is like, I need to pull my money out. That's not really how this works. No,
you're spot on. It definitely goes both ways.
Yeah.
Just like any relationship, right? Has to work for both sides. So for sure. But I love fielding the good, thoughtful, hard questions because it makes sure that we're on top of our game. We're not just putting a deal out there just to put it out there. Just it gives us a chance to make sure that we're looking at things correctly and communicating things correctly too.
Yeah. Well, awesome, man. It's been great to speak to you. Is there any other better place to get in touch with you other than through the site at belrosestoragegroup.com?
That's the best place to go right there.
Yeah. Awesome. Well, I appreciate you spending the time. Glad we could knock out another self-storage episode, teach people a little bit more about what is generally one of the most passive investments out there, especially in a syndication. So I appreciate it. And I look forward to staying in touch.
Sounds great, Jonathan. Thanks so much for having me.
Yeah, all right. That was Tom Dunkel, the Chief Investment Officer of Belrose Storage Group. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to find out who the next guest on Zen and the Art of Real Estate Investing is. And if you haven't left us a 5-star review yet, I would really appreciate it. Wherever you listen to your podcasts, if you just go in there, click the 5 stars, write a little blurb and tell us what you like about it. I always read them and I would really appreciate it. Next episode, we're going into a new topic and I really like it. We've barely talked about this, so we're going into build to rent. My guest is Jim Shields, and he, along with his wife, wrote the Passive Income Playbook, leveraging build to rent real estate to buy back your time and create a legendary family life, because the backbone of Jim's business is to create that family life. I hope you're excited for a build to rent episode Next Up with Jim Shields. See you then.